Good morning and happy spring, everyone. Welcome to Planned Financial Services Market Noise Live, Managing Market Volatility and Uncertainty. My name is Frank Fantozzi, President and Founder of Planned Financial Services. Myself, Cynthia Yang, and Chelsea Hussey will be the hosts today, discussing what's going on in the markets. This program is something we started last year. We've gotten great feedback. That every 6 months, kind of doing a pulse of what's happening in the marketplace has been very helpful to kind of basically separate the wheat from the chaff, as we say. Everyone's bombarded by a lot of news and trying to figure out, what's real and what's not, and what does it mean to me as an investor is important. So we have a full schedule today. We'll be talking approximately 45 minutes, and then we'll allow for 15 minutes of Q&A. So on the bottom of your screen, you should be able to hit a button and pose some questions that we'll answer as best we can. Sometimes we get surprised, but hopefully we'll be able to answer those questions. So thank you for being here and participating. We will also make this available as a recording. So if there's something that was missed and you want to reference it back, or you'd like to share it with a friend, please do so. So we're going to hop right in, and as I always like to say, well, you're going to see a couple slides. I always like to joke about legal disclosures. You're going to see a couple of them. Basically, the program today is educational in nature, and there are no guarantees. So that's a simple way to say what all this legalese has to. This is what we have to do when we deal with the SEC and FINRA as part of our compliance obligations. So I don't want you to get eye strained trying to read all this. But I'm going to start with some opening remarks before we really get into the content today. So like I said, every journey has some mile markers that precede it. And so I feel to create context, we need to go back and look at some of those mile markers and why we are here today experiencing what we're experiencing. So I think everyone remembers a little bitty event called the Great Recession, which occurred between 2007 and 2009. There were a couple of things that really created the Great Recession, and we're not going to have time to go in depth into each one of those and what they meant, but there were about 5 of them. One was the housing bubble and the subprime mortgage crisis. That was really basically, you saw housing prices going through the roof, relatively low interest rates, and then bad lending practices contributed to the housing bubble and the subprime mortgage crisis. Add to that, during that time, we were going through a period of financial deregulation. So loosening standards, and then institutions were taking advantage of those loosening standards. And, the complexity in the financial markets created these products called derivatives and securitized debt. And so those are things that really became a problem because no one understood what went into those derivatives and those securitized debt. And because we are a global economy, those instruments were sold worldwide. And so when things started going bad and started going south, it impacted not only the United States, it became a worldwide crisis. And then add to that, again, bank failures. The biggest one was Lehman Brothers. And then the decline of consumer spending. When you throw all of those into the pot, it created, what they call the Great Recession, and it was something that lasted a little over 2.5 years. You saw equity markets drop a little over 50%, and put quite a scare. Now, in the rearview mirror, in hindsight, we've come a long way from the Great Recession in regards to our financial stability, and even with what's happened the last 3 years, we are still financially in a much better place than we were during the Great Recession. A key thing to keep in mind, though, is the byproduct of the Great Recession. To help get out of the Great Recession, the government really, or the Fed, really lowered interest rates to basically a zero interest rate environment for 10 plus years. And while everyone was getting fat and happy, and why rock the boat, this really created some underlying challenges that really manifested itself into the situation we're at today. Besides killing, mid to conservative investors who really rely on fixed income and bonds in their portfolio, it also drove some of those investors in seeking, total return to go into the equity markets. So because of that, equity markets were further driven up in value. And candidly, during that whole time period, everyone was feeling great. I mean, we really only had one bad year, which was in 2018. The S&P 500 and the Dow Jones, which tracked pretty close together, were down approximately 6% for the year, while bonds were still, positive for that year. So I think that helps create some of that perspective, because anytime you have excess in any part of the market, eventually it whipsaws back. And when COVID hit, which was the next mile marker, we were at that time right before COVID. We had a very low inflation. We had zero interest rate environment. Unemployment was basically negligible. And so you had this really euphoric time, and hence everyone was really benefiting it from a financial standpoint. Then COVID hit. And with COVID, the government really was faced with an unprecedented challenge. And they decided to really shut down the economy and forced what I call a very short mini recession because of that. Now, to get there and to protect the economy, the government infused $2.8 trillion into the economy. So think about having a bonfire. You had this pretty hot economy going, and then just throwing gasoline on it. And that's basically what happened. $20 trillion hits the economy. They knew back then, and they publicly stated it. I feel sometimes, many people forget this, but they knew inflation was going to be forthcoming. And the reason why the government chose that path was they've dealt with inflation in the past. They felt they had the tools to deal with it. And it was dealing with the devil they know versus the devil they don't. Now, because of the bonfire just really exploding and getting big, the Dow Jones, November 1st of 2021, and the S&P hit their all-time highs. We were at 36,300 approximately for the Dow Jones, and the S&P 500 was at approximately 4,700 points. So when people were getting their year-end statements, again, everyone was feeling really, really good. But then, inflation, came to roost. And because of that, the government, which we believe here, and I think a lot of people agree, and while hindsight's 2020, I think the discussion was well in advance that we were trying to, people were trying to talk to the Fed about slowly increasing rates to a more of a historical norm to create that balance in the economy. Well, they waited too long. And in 2022, the government, or the Fed, increased interest rates, their largest amount over the shortest amount of time, and created this, what I call a death spiral in the markets, because it drove the equity markets down and it drove the bond markets down. So that's really how we started this year. And we're going to kind of get into where we're at today, but that's how we got into 2023. We ended 2022, obviously, with the markets being very depressed, and since have rebounded slightly. So everyone's curious where we're going to go from here in 2023. So with that, we're going to start, and I'm going to talk about the agenda here. These are going to be the key themes and mindsets that we're going to talk about today. Inflation and debt ceiling. Now, I have to be candid. When we created this originally and submitted this to compliance, and we were setting this up, debt ceiling wasn't even on this. We really just added it this past week because we really didn't think the debt ceiling was going to be that big of an issue, but it's become one, and we're going to talk about it today. We're going to talk about Fed tightening and the interest rates. Are we really heading to a recession? Again, focusing on principles of long-term success in investing. What are some of the positive trends and tailwinds? And then portfolio implications and positioning. This is really to look at things maybe a little more short-term than really what long-term that the outlook will be. So with that, we're going to jump right in here, and we're going to talk about the debt ceiling. And you see in big red, I didn't want to put 34 with a T after it, because I think it minimizes how big a number 34 trillion really, really is. And so the recap, the debt limit caps the total amount of allowable outstanding US federal debt. So this is spending that's really been on the books. We've actually made the obligation to incur certain expenses. So this is not about authorizing new expenditures. This is really about paying for things that we're really currently obligated. And you've heard, Janet Yellen, warn that if the U.S. doesn't pay its bills and fast, during, with the fast approaching deadline, which is the end of this month. Potentially the, U.S. economy or the U.S. government's actually going to default. So I want to put this really again in the context, because again, we keep hearing all this news, and I'm not saying the debt ceiling, we're not saying the debt ceiling is not something serious, but to put debt ceiling matters in context. And if you really go back in history, if you go back to 1960, the debt ceiling has been raised 78 times. And if I do my math right, that's more than, there's less years between 1960 and 2023 than there is 78. So you can see how often the debt ceiling has been raised. And actually in current events, between 2001 and 2016, the debt ceiling has been raised 14 times. So this is not something new. It has often come down to crunch time. And our prediction is that, probably within 48 hours of the deadline, that they're going to reach some type of temporary solution. And then, maybe kick the can down the road for summer discussions. But it's highly unlikely the U.S. government is going to default, because the implications are very, very large. Besides downgrading the U.S. debt, it'll most likely, and you're seeing the volatility pick up in the market the past week and a half, both in the equities and fixed income. This is all due to everyone posturing and understanding what's happening with the debt ceiling. And again, as a firm, we feel that it's most likely that it's going to be a last minute deal that gets cut. And unfortunately, we live in a two-party system. In a two-party system, you have this argument going on between both sides about what they want to posture for. And so the debt ceiling and fiscal policy has always become a political football, each trying to, basically play chicken with one another to see who's going to blink. And, before both cars crash, I think they're going to, miss each other, come to an agreement, and kind of move on. But to be serious about how big a number this is a serious amount of debt that our government really carries, and why there's always a lot of talk about trying to create more fiscal responsibility. Key thing to keep in mind why this is a huge number. If the focus has really been growing the economy and the gross domestic product, the GDP, if the relationship between the debt ceiling and GDP stays relatively the same, then it's kind of like the equity in your home. If you think about it, if your house keeps appreciating and you keep borrowing against your house, as long as that ratio stays relatively safe, then you're not really in a problem. But the problem is you can have a housing crisis like we did back in 2007 and 8, and if the value falls, then you do have a challenge, because then you can't afford to pay the debt. So that's why there's a big focus on continuing to grow the economy. But at the end of the day, we still need to focus in on, the implications of the debt ceiling and the negotiations that are going to go on. Again, we feel that this is going to get resolved next week, and most likely will be resolved within the last 48 hours of the week. So with that, we're going to get into inflation, because that really was the big headline going into the presentation today as a key point, because everyone's concerned about inflation, and you're going to see a busy graph here, and I want you to really kind of focus on really the red and green lines. Inflation is trending down from the peak, so let's just get the good news out in front. Regardless of what you're hearing in the news, inflation is heading in the right direction. And the two that get talked about, the two inflation numbers that get talked about is headline inflation, which has all commodities, services, and goods. And then you hear this term called core inflation, which excludes food and energy because they tend to be very volatile. So the blue line is headline inflation, and the black line is core inflation. And if you look far to the right, you'll see the red lines, which correspond to the peak about a year ago and to where we are today. And you can see there's been a big drop in headline inflation. And even core inflation, because that number is tighter, you're not going to see as big a gap. If you look at the green lines that go across, you're going to see a tremendous drop. So headline inflation at the peak was about 9%. And headline inflation right now is a touch under 7%. And then if you look at core inflation, which again, it was without food and energy, core inflation was approaching 7%, and right now it's about 5.8%. So we're heading in the right direction, and that's really a key point and key takeaway. Now we're never going to go back to pre-COVID numbers, so that's not going to change. There's always a certain amount of inflation when we have it. It's always going to be built into our costs going forward. But the other thing is, having some inflation is a good thing, because that's usually the sign of a healthy economy. Because if an economy is growing, where wages are a big part of companies and their product and or service, you will see that in a growing economy, there's going to be demand for labor, and that'll drive up wages, which should drive up costs. So again, the target for the Fed, they have this dual mandate of a low unemployment number and a low inflation number. Their goal is to bring it back down to 2.5% to 3%. And I think that's going to be achievable probably in the next year and a half. So again, we're heading in the right direction. The next graph is called an inflation heat map. And I want you, don't worry about reading it. I want you to really focus on the colors. You got green, light green, yellow, orange, red. And if you look at the left in the first column, you'll generally see a lot of green. This is going back to March of 2021. And it focuses on energy, food, core goods, core services like shelter. And you see back in March of 2021, it was relatively green. And as you move into 2022, the colors change dramatically. We go to yellow, a lot of orange, a lot of red, and that's where inflation was peaking. And if you go to the far right and you look at as of February of 2023, you start to see more yellow, more light green, green. And the only area that's remained orange, has moved from red to orange, is core services, which I'll talk about in a second. So again, our goal here as financial advisors is to really look at the data and what the data is telling us, and not to get caught up in the emotion, which is what I think a lot of the news is about. It really focuses on creating a level of panic and concern. As Italians like to say, it's called agita, which is like creating kind of an upset stomach in your gut. So the news is really good at that, but that's what they're selling. They're trying to sell sensationalism. And when things are bad, you should call it what it is. But when things are improving, you should call it what it is. And when you look at inflation, it is heading in the right direction. And people also have to remember, it's not like a light switch. It's not like you implement changes and within 30 days, things are going to change. Things have to work their way through the economy. And you've seen that through the Fed's introduction of the interest rates and pushing interest rates higher to slow down the economy. That is not a science. It's kind of a gut feel as to how fast that will implement and impact the economy, but it is happening. The only area that stayed, again, just to touch on core services, is shelter costs. And a big part of that is apartments and leases. And if you think about it, a year ago, if you had to enter into leases, those leases stay on the books for a year or 2 years. So shelter costs are usually going to be a lagging indicator. So we would think 6 months from now, when we redo our seminar, and we have this heat map showing, we expect that red and orange to start to dissipate into a light orange to yellow. So there's always a lagging indicator when you come into core services. So that's our take on inflation. The inflation is heading in the right direction. You might not feel it all the time, go to the supermarket, but the costs are coming down. The next is, we're going to talk about the Fed and interest rates. And keep in mind, the Fed has two tools at its disposal. It can create, you can go to the next graph. It could either control interest rates, the cost of borrowing, which changes, potentially the use of money in the economy. And it can also change the money supply by buying and selling bonds. And again, if you look at the graph on the left, which looks at all central banks from the U.S. government, the Bank of Japan, the European Union, and Britain. What you'll see is that the amount of bond purchases is decreasing, which means that they're trying to put less money in the supply, which is another way of tightening up the monetary policy. So you can go back to 2021 where you saw the peak. And why were they doing that? They were trying to put money into the economy because of COVID. And now it's trended greatly down. Now you'll start to see probably towards the end of this year, probably more next year, that the governments will start buying more bonds to put money back into the economy to kind of get us moving again. So we've talked about, the Fed's talked about this, what we call it a soft landing. And a soft landing, if you think about an airplane trying to, you've been on airplanes where the pilot takes you in and you barely feel you land on the runway. And then you see some of these pilots feel like they've never flown before, and you're jumping along the runway. Again, this is not an exact science. And so what the Fed is trying to do is get all this excess that's been in the market the last couple of years to dissipate. And to them, a perfect solution is having a slow growing economy that's below normal expectations. That'll tell them that the economy, all this excess is dissipated. And their hopes is then to set the stage for our next bull market run. And if you think about every 10-year cycles, you tend to have a bull market within a 10-year cycle. And the last was our longest. It was 131 months long, and then it was interrupted by COVID. So that's what they're playing for. And if things go well, we should hopefully land, relatively softly by the end of this year, and things will be dissipated enough that the government will start to, the federal government and the Fed will start moving to trying to get the economy to be a little bit more robust as we get into 2024. The graph on the right is your historical policy rates and that you see from a lending standpoint. And again, if you look at the highlights, and I highlighted our federal government in yellow, and you can see where we're heading. Interest rates are going to be when you based on future projections are going to be coming down, and we're predicting, looking at these curves, that our federal government guideline will be around 3% off of the high that we've had. So again, we're moving all the right directions, and if you look at the other countries, they're all kind of following suit as part of the playbook of controlling, the monetary policy. And so we feel, again, we're heading in the right direction. The government has told, or the Fed has told us what they're planning on doing. So it's not a surprise. It's baked into the economy already. I mean, as soon as the government kind of figures out what they're doing and they make their statements, it's already built in. The only thing that throws the markets off is if they get surprised. And right now we're hoping, again, going back to the debt ceiling, that doesn't become a surprise. That they do end up resolving it. But until we get there, you're going to see this bouncing in the markets this week and next week. And the next slide has to do with nominal and real interest rates. So take a step back. Interest rates represent the cost of borrowing and the return on savings and investing. And typically, they're expressed as a percentage of the total amount of a loan or investment. So that they can have a total return lenders receive when they offer loans, or when people earn money, on bonds or what they have in the bank. And interest rates then can really be expressed in nominal real terms. And a nominal interest rate equals the real interest rate plus a projected rate of inflation. And a real interest rate reflects the true cost of funds, the borrower, and the real yield to the lender or to the investor. And what this chart goes and looks at is both nominal and real interest rates from 1958 through the present. And if you, again, I would just focus on the tail end to your right. You'll see that, we've gone through from 82, which was the peak. You guys remember 1979, 80, we had interest rates in high double digits. We've come down to this low interest rate environment, which we experienced from 2010 through COVID. Then we had the spike, which you've seen, and now coming off that spike, you're seeing that these the nominal and real interest rates have both come down. And again, the data is supporting the trend. And as investors, I think what you're going to see is that we're going to come back to a new norm. We're not going to go back to pre-COVID interest rates. We're not going to go back to a zero inflation, zero interest rate. And there's a big reason for that. As I told you earlier, the federal government has two tools at its disposal. It could either change money supply or change interest rates. So they're going to want to have some cushion in the interest rate so that if in the future we run into a situation where we got to lower interest rates, they can actually lower. You can't really go to a negative interest rate. So having an interest rate of 3 or 4% and giving them room to bring it down if the economy needs an extra kick in the pants, that will happen. So again, the key recap off of my section is that inflation's heading in the right direction. Interest rates are heading in the right direction. Again, they're probably never going fast enough for most people, but as U.S. citizens, I think we should feel confident that we're moving towards hopefully a soft landing. And even if we, and I don't want to take away anything from my co-hosts, but I think we're going to be in a position where in 2024 we're going to be looking to start hopefully expanding at some point. So with that, I am going to pass it on to Chelsea, and she'll get into possibilities of a recession. Thank you.
All right. Good morning. We're going to look at some recession determinants here with this next slide. Now, a typical back of the envelope definition for a recession is 2 consecutive quarters of negative GDP growth. But the more unofficial scorekeeper is actually the National Bureau of Economic Research, and what they're tracking is broad declines across a variety of variables, and that's what this chart is looking at. So this is going month by month back to 2019, and similar to the inflation heat map you saw, this is also a heat map, with green meaning that there was an increase in that variable month over month, red was a decrease, and then the shading or the boldness of that color tells you how intense or strong that increase or decrease was. So let's just take a look at March and April of 2020. You can see that there's 2 columns of red right there. That's COVID and then the response to COVID with the economic shutdown. Now, as we move past that time, so as we're looking into 2022, you can see that there was a lot of variability, a lot of volatility with each of these indicators. But as we move towards the end of 2022 and into 2023, you can see that the intensity has waned somewhat. And really the only area has persisted with a little bit of volatility has been a real wholesale and retail sales, which we think is likely just a product of inflation. Now, the chart below this is the City Economic Surprise Index. And what this is tracking is when economic conditions have been better or worse than consensus expectations. So a reading above 0 means that things are better than expectations, and below 0 is worse. So as we look again at 2022 and heading into 2023, you can see that the economic data have been beating expectations somewhat, mostly modestly. And so while none of this indicates that we're currently in a recession, these will be the variables that we'll continue to track as a good gauge. We'll go on to the next slide. Now, this next section is looking at 4 key cyclical sectors and how they're performing. Now, when you hear the term cyclical, I want you to think sensitive. So a cyclical sector is sensitive to what's going on in the economy. A non-cyclical sector might be something like non-durable goods or pharmaceuticals. People are going to continue to buy food and medicine regardless of what's going on in the economy. So this is looking at 4 cyclical or sensitive sectors: residential investment as a percentage of GDP, business fixed investment as a percentage of GDP, light vehicle sales, and total business inventory to sales ratio. And what we're looking at here is we want to examine the trends across these 4 sectors to look for any areas where they may be overextended, which would then indicate perhaps a bubble, which would then precipitate a recession. And as you can see, none of these four areas are overextended currently. Really, the only one that's trending down a little bit is residential investment as a percentage of GDP, which may just be a product of high interest rates right now. People are certainly less likely to go out and get a mortgage with high rates, or maybe take out that home equity loan at this time because those rates are so high. We'll go to the next slide. All right, this next slide is nice because it gives some really good, I think, historical perspective. So we'll take a look first at the chart on the left. So the chart on the left is taking a look at a portfolio invested 100% in the S&P 500 that had a peak value in January 2022 of just under 4,800. And so what we're looking at is then if we go 1 year out, if you wanted to get back to that peak value of about 4,800, and you were invested 100% in the S&P 500, in 1 year, you would need an 18.5% rate of return to recoup that loss. If we take a look at what happens 2 years out, that rate of return required is cut in half and then reduced even further. Now, this is for a portfolio that's invested 100% in the S&P, but keep in mind, the average investor is much more diversified than that. And so a diversified portfolio will take less effort and a shorter amount of time to rebound and recoup some of the losses from those peak values. Now, the chart on the right, what this shows is some historical context of bull and bear markets. This is going back to 1926, and it shows the beginning dates of these bull markets and bear markets, their returns, and then their duration. Now, if we go to the bottom here, you'll see that the average bull market was about 51 months. The average bear market was about 20 months. So even though bear markets have been certainly painful in terms of duration, they actually haven't been super impactful. It may just feel that way. And then just an interesting piece, I think, for historical context, if you take a look in the bull market column at March 2009, 401% return and 131-month bull run. Oh, so that's over 10 years. What's very interesting about that, at least in my view, is if it were, let's say, March 2009, and let's pretend you call up your friend and you told them, all right, it's time for the new bull market. The new bull market has started. I'm going to get in. I'm going to start investing. They might have told you that you were crazy. They would have said, are you kidding? Things seem pretty bad right now. You think this is the start of the new bull market? But this, I think, all lends itself to that great Warren Buffett quote, be greedy when others are fearful and fearful when others are greedy. So I thought that was just an interesting perspective there. Now we'll go to the next slide. So these are principles for successful long-term investing. Now what this next slide illustrates is market returns becoming more predictable over time. For most people, this might seem pretty straightforward, but then again, we also know that common sense isn't terribly common. And so as we look here, we have at the 1 year chart, stocks returning a peak of 47% or as low as a dip of minus 39%. And then we have the blue bar representing bonds, and then the gray representing a 50-50 portfolio, 50% stocks and 50% bonds. Now, if you just go from a 1 year return to a 5 year rolling return, you can see in all three of those areas, but particularly the diversified portfolio, that downside risk becomes mitigated. And so this all lends itself to the importance of having a diversified portfolio and an appropriate time horizon. All right, this last slide for this section is taking a look at a balanced portfolio providing positive returns 82% of the time. I would take those odds any day of the week. That's better than gambling. So what we're looking at here, it's a little bit tough to see, but you have these this data going back all the way to 1950. So this is 72 years worth of data. And we have the green bar representing stocks, and this would be the S&P 500. The gray represents bonds, and this is represented by the Bloomberg US Aggregate Index. And then that small blue triangle represents a 60-40 portfolio with 60% stocks and 40% bonds. Now you can see most of the time when equities or stocks are low, bonds have tended to be neutral or positive, which has then helped balance out a 60-40 portfolio. But if we take a look at 2022, we can see that that was actually the worst year for the performance of a 60-40 portfolio since the mid-1970s. Now, if you were to follow a lot of financial bloggers or podcasts, a lot of them were saying at that time, hey, is the 60-40 portfolio dead? It certainly isn't dead. It was just historically a pretty rough time for that market. But you can see that as we look over the long run, we have, going back to the 72 years worth of data, positive returns over 3/4 of the time. And so this all speaks to, again, making sure that we're balanced and that we have a longer term time horizon. With that, we'll go to Cynthia to introduce this next section.
Thanks, Chelsea. Good morning, everyone. We have spent a good chunk of time discussing about the concerns in the market and what are the potential tailwinds in the market. Those are all valid concerns, and luckily we have seen some improvement since the last time we spoke. Now let's focus on what might be the positive trends or the tailwinds in the market that we've seen. The first one we are looking at is the interest rate, which is the risk-free rate. This chart shows us on the left what is the risk-free rate for the last 10 years, and on the right shows us where we are standing at the end of 2022. So a risk-free rate is an interest rate that an investor could expect to earn without taking on any risks. Normally, the Treasury bill yield is considered as a risk-free rate because it is backed by the US government with low rate of default, and it has, because of its short term, there's very little interest rate risk. Now, when we look at the Treasury bill yield last year around the same time, it was around 1%, and keep that in mind, that was already after couple rate hikes Fed done. And right now we are at 5.25%, 90 days Treasury bill yield. So what does that mean to us? For the past decade, with those really low risk-free rate, any investor has a target return in mind. See, if you are a balanced investor, for your portfolio to generate a return to support your standard of living after you get retired, you're looking for a 6% rate of return. Now, when there is ultra low risk-free rate, we are pushed to take on higher risk in order to generate that 6% rate of return. But as where we are right now, when the risk-free rate is around 5%, 5.25%, we don't need the portfolio work, the risky portion of your portfolio working that hard, meaning that the risk-adjusted return going forward are very favorable, are very, very attractive right now. And another way looking at it is, if the risk-free rate stay at this level for a longer meaningful time period, it means that we don't need to take on as much risk as the last decade to get us the 6% return we're looking for. Now, on the other hand, if Fed decided to cut rate next year in 2020, end of 2023 or in 2024, that means that your bond portfolio are expected to generate, not only give you the yield that you're getting right now, 4%, 4.5%, you are potentially going to get a really good capital appreciation on top of that because of that falling interest rate. So 2022, it was a painful year. It was one of the unusual years that every investor experienced, with both bond and stocks generating a 2-digit loss. But heading to 2023, it gave us a really good resetting point and set up with a good foundation going forward, that our balanced portfolio are able to generate a much more healthier return in the long term. The next slide is another way looking at how bond has been acting in our portfolio. Most of investors are not putting all the investment in the stock market. So bond is a really important component of your portfolio. Now in 2022, the broad measure of both the largest US asset categories, the large cap stock and the investment grade bonds, both posted double-digit losses for the first time since 1926. Now, historically, the bond market normally generate a gain during the calendar years when the stock market were having a loss, which make 2022 a really difficult, challenging year in the history of portfolio diversification. Now, with U.S. aggregate bond yield at 4.4%, and Fed is almost near the end of its rate hiking campaign, the bond market are now expected to be more predictable with a decent amount of yield, and hopefully when Fed started to cut rate, it's gonna give us a maybe 2 to 3% capital appreciation on top of that. Now we have all the discussion about the inflation, the Fed rate hikes, the potential debt ceiling issue that we are experiencing, and whether there's going to be a possibility of a recession. But what does this discussion really means to you and your portfolio? The two implications that we're going to discuss today is the first one. When we look at the asset allocation wise, we remain focused on large cap equity stocks, high quality stocks. The chart on the left can show a mix of the market sectors in large cap and small cap stocks. Large cap tend to have a more healthy mix of sectors with lower leverage. When you look at the large cap, they tend to more weighted into the information technology, the consumer staples. Those are the sector tend to have a lower leverage ratio. On the other hand, when you look at the small cap, those are really made up of the sectors like energy, utility, material, real estate. Those are the sectors tend to have higher leverage ratio, which means those markets tend to be more cyclical than the large cap stocks. Now, the chart on the bottom right illustrates a kind of similar story from a different angle. An interest rate coverage ratio measures how well a firm can pay the interest rate due on outstanding debt. While the current ratio for both large cap stocks and small cap stocks still sit above the long-term average, which telling us, well, there is a little bit of cushion there, but the large cap seems to be more healthy. There is a much better cushion for the large cap stocks. And for small cap, especially, those are the companies tend to have a higher potential, higher portion of their debt, which are floating rate debt, meaning that when the Fed raise rate, those small companies with carry more of the floating rate debt tend to pay more interest rate going forward. The top chart on the right shows us for the Russell 2000, which is the index indicate for the small cap stocks. And when you look at the chart, it shows us how much of those companies in the Russell 2000 are not really making a profit. By the end of 2022, the last quarter, we have 41.6% of those small cap stocks are not really making a profit, which means for those investors who put your money into a small cap ETF, you're putting 40% of your money in those companies are not really making a profit, which means those companies are less likely to generate a good return for you during the long run. So with that, we really tend to focus on the large cap, have a lower leverage ratio, healthier balance sheets, stronger cash flow reports. And when it comes to small cap, we want to make sure that we work with the right active manager, being more selective than putting money into the ETFs. And lastly, we would like to spend a little bit time to discuss about CD. CD rate right now is around 5% with a guaranteed return of principal, which is very attractive. Many investors may wonder now, if we are still going to see the short-term volatility in the active market and the CD are providing us a 5% rate, why don't we take the money out and put that into the CD? Now, if you have done that as beginning of the year, you may earn a little bit over 2% guaranteed return as of year to date from your CD investment. But when you look at where we are today, the S&P has about 8% year-to-date return, and the large cap growth stock has a great rally this year, about 26%. That's the great rally you're probably going to miss if you put your money at the beginning of the year into the CD. On this chart, we also look at after the CD rate peaked, how are the CDs and the investment grade bond have been generating returns for the following 12 months. For all those periods, for the last 6 periods of time after CD peaked, we have seen the short-term bond, the core bond, and the core plus bond all generate better attractive return than a CD. So that is really telling us, yes, the CD rate right now is very attractive, but there are much better opportunity out there in the bond market. And the last point I would like to remind everyone on this page really is CD rate right now is attractive, but if you're looking for a long-term CD, 3, 4, 5 year CD, be mindful that those CD all have a callable feature, meaning that when in the future, say in 2024, Fed decided to cut rate, the market rate are much lower than where we are today, and you put your money into a 5-year CD this year, next year, the bank can call your CD back, push the principal back to you, and at that point, the market rate available is a much lower rate, which gives you a higher reinvestment risk. So those are the things that we want to make sure that you understand how the CD really works, and there are better opportunities right now in the market. So what really are the key takeaways from today's discussion? We discussed about the inflation. The peak headline inflation was June 2022. It was around 9.1%. The April headline inflation now is about 4.9%. The stickier component of the inflation, shelter price, will likely to be moderating in this summer after the new lease contract get renewed. We also discussed about the possibility of a recession. Our market and economy has been very resilient recently. The corporate Profit margin is on track to rise quarter over quarter in Q1 with a better cost control and a solid revenue growth. April's unemployment rate is still around record low at 3.4%. We believe the likelihood of having a recession this year is decreased from the last time we have spoke. Now, we also discussed about the principle of a long-term investment success. Sectors and asset class rotate from time to time. Growth stock was the worst performer in 2022. Anyone put money in the growth stock suffered a loss. Well, there is a valid reason for that loss. Now, this year, when we look at 2023, growth stock becomes the best performer. Chasing the best return could potentially hurt your performance over the long run. If there's any concern that you have about your investment, I would encourage you to discuss that with your advisor. Once you determine what should be the long-term strategy and that strategy being implemented, stay in the course is the key for your financial success. And lastly, we remain focused on high-quality stock and bonds until we have more clarity about the market and signs of early expansion. That concludes our presentation for the day, and we are happy to address any questions you may have.
There you go. God, I was muted. Sorry. So there's a little Q&A box at the bottom of your screen. If you want to type a question in, please let us know. We're going to hang out here for a little bit because in case anyone has questions, but we really do want to thank everyone for being part of the webinar today. Hopefully you felt that we focused on the key issues that were probably on the minds of most investors, and that we addressed them with a level of clarity and impartiality so that you feel, moving forward, that you have a sense of control over what you feel is going to occur. Again, with the debt ceiling, we do feel that that's going to come to a positive end probably by the end of the next week. But until then, do expect the markets to gyrate quite a bit because again, the parties are playing chicken. Both thing two cars coming at each other, who's going to blink first and continue to go straight. Both are just going to weave off of one another and both end up in a gully, and they're all going to have to come up with a decision as to what works. But again, it's commonplace. Again, we've showed you how many times the government has raised the debt ceiling. So I think it's almost become kind of like the halftime show at the Super Bowl. It's like, okay, what dynamics are going to be different this year? But it's the same dynamics. Oh, we have a question here. Let's see. So what impact is the Ukraine war having on the market? So any of my co-hosts want to take that one, or want me to? Okay, I'll go first. So what's happening with the Ukraine war right now, and again, it's very unfortunate. It's already been baked into the market. That's the quick answer. There hasn't been really much more success from the Ukraine side or the Russian side. It seems like they've been really, at a stalemate despite the news that we're hearing. If you recall, between 2000 and 2010, there was another Ukraine conflict. There are conflicts that are happening all the time around the world, but there hasn't been a major change in gas and food supply and things that are coming out of Ukraine at this point that it's going to impact the rest of the world. So I think right now Ukraine, barring a major shift in the war, there's not going to be any additional change in the market. Thank you for the question. We do have another question. Where do we feel the Dow and the S&P will be at year end? So I'm going to let Cynthia give her a chance on this one.
Thank you for that.
Get your crystal ball out.
Yeah, well, we do feel like this year, by the year end, we're going to have a positive year this year. either is a low single digit or a middle single digit number there, we are confident that we're going to close this year in the positive territory. Now, the road down to the year end might be a little bit volatile. It depends on where the debt ceiling, when and how the debt ceiling issue is going to be resolved, and a couple other noise in the market. But we are confident that this year the market going to close in the positive territory.
Yeah, and the same goes for the bond market as well. We do feel it's going to be a positive overall market. So I think, you know, the pain of 2022 hopefully will ease, and hopefully the stress. And that's one thing I want to talk about real quick. You know, what was really different about ending 2021, you know, we were still in the midst of COVID. Financially, when you looked at your investment statements, you were feeling great financially, but overall as a country and as a world, we weren't feeling that great, because we've just been dealing with a stressful time. So I think where we got taxed a little bit is when 2022 hit. You know, the markets, you know, both collapsed. The bond market and the stock market collapsed significantly, and we didn't really have a lot of what I call emotional reserve to deal with it. And you know, that's part of investing. I mean, everyone has a different relationship with money and a different way they view risk. And when you're feeling good about a lot of things in your life, and you know, you're dealing with some financial stress, you're usually in a better position to make good decisions because you're less emotionally compromised. But when we're in the midst of dealing with COVID, and you know, COVID impacted people very differently, from either loss of friends or family, or just, you know, the way your lifestyle worked. I think that really made 2022 a lot harder, because we've had down markets before. Again, less frequent when you have the bond and stocks go down. But I think that made 2022 a lot harder to deal with. So the fact that we've moved out of COVID and we're starting out, you know, we're having a resemblance of a normal lifestyle, I think will help. And once we get through this part of the conundrum, you know, again, remember, the reason why we ended up in 2022 had to deal with all the stuff from the Great Recession to, you know, COVID being a triggering event, and then, you know, kind of letting the house of cards fall. So I think we need to get to that new norm. And I think hopefully with some more emotional stability, we'll also deal with some of the market volatility in a more common sense approach. Any other questions? We still have, you know, a few more minutes if anyone wants to throw a question at us. Actually, we did a lot better this time. I remember the last time we did this, we were way over time. So I think we're kind of picked the number of slides correctly that we wanted to cover. I don't see any more questions. So again, on behalf of Plan Financial Services, myself, Cynthia, and Chelsea, we really want to thank you for being part of the webinar. Again, hopefully you walked away with some good information to make you feel informed about what's happening in the marketplace. And if you have any questions afterwards, again, feel free to reach out to any one of us. I don't know if you want to have the slide up, Cynthia, that has our contact information, that for those that don't.
Yep.
There we go. So if there's any questions, please feel free to reach out to us. I'll be glad to do any one-on-ones. If you need a second opinion on something, for those that are not clients, you need a second opinion on how they're handling their finances, we'll be glad to talk to you. Again, thank you so very much. Have a very happy spring. Looking forward to summer and a lot more normalcy. So take care, everyone. God bless.